Hello everyone. This video is a comprehensive guide about the trading strategy called the combo algorithm. I will try to explain each aspect as clearly as possible, and for this reason, this video will be divided into 5 important steps. Step 1. Variables, functions, and timeframes. Step 2. Logical elements. Step 3. Combo. Step 4. An important rule, trouble area and first trouble area. Step 5. Examples on real charts. Let's get started. Step 1. The first aspect, variables. In trading, just like in mathematics, we can easily use certain variables that can take unknown values within an idea. This allows us to be maximally flexible in rapidly changing market conditions. Thus, we have only 4 of the most important variables that we use both in market analysis and in opening positions. The first 3 are order block, rejection block, and fair value gap. We also call them volume tools, or inefficiencies. And the last one is fractal low or high, which we often refer to as liquidity. Throughout this video series, I will explain the logic behind all these tools in detail, but for now, let's just illustrate schematically what they look like and their basic characteristics. Order block is a price action element that has performed a liquidity raid or rebalanced a fair value gap. After that, it breaks through resistance or support levels and closes with the body of the candle above or below. Here you can observe the break through a resistance level, the buy plus sell candles, and the close with the body higher, which forms the zone of a bullish order block. And the break through a support level, the sell plus buy candles, and the close with the body lower, forming a bearish order block. The next price action element is the rejection block, which is formed by 2 candles where the wicks of the candles have performed a liquidity raid or rebalanced the fair value gap, forming the zone of the rejection block. Sell plus buy candles form a bullish rejection block, and buy plus sell candles form a bearish rejection block. It's very simple. It is not mandatory for an order block or rejection block to perform a liquidity raid or fair value gap rebalance, but this is a very important condition for their strength. The last in the category of volume tools is the fair value gap. It is also a price action element formed by 3 candles where the maximum of the first candle does not cover the minimum of the third candle for a bullish scenario, and the minimum of the first candle does not cover the maximum of the third candle for a bearish scenario. The fair value gap does not always form after a liquidity raid or rebalancing of a fair value gap, but this is a good indicator of its strength. As for fractal highs and fractal lows, I believe everyone is familiar with them, so there's no need to explain something. The second aspect is functions of the variables. Generally, the variables can have only a few basic functions, and these are: the volume confirmation function can only be performed by order block, rejection block, and fair value gap. The inducement function can only be performed by fractal point. The trigger function can be performed by fair value gap or fractal point. Execution or entry into a position can be performed by order block or fair value gap. And as a trouble area, it can be a fractal point or a fair value gap. Now this might seem hard to understand because it's difficult to remember all these elements, but as we go along, everything will become much easier. The third aspect is time frames. Here, everything is very simple. In accordance with intraday trading, we use the most popular and widely available timeframes for everyone. These are 1 week, 1 day, 4 hours, 1 hour, 15 minutes, 5 minutes, and very rarely 2 minutes. All these time intervals can be arranged in an order that resembles a staircase. Naturally, the larger the time frame, the more important it is for us because it provides stronger variables. Every time we start analyzing the chart, we begin from the top down. According to logic, each stage should provide a variable that we can synchronize with one of our ideas. If a stage does not provide any information, then there is a gap, and we do not proceed further, but wait for new variables. Step 2. Logical elements. But before we move on to the logical elements, we need to determine and understand a few symbols that we will use throughout. The symbol V will always mean the word variable. For example, V1 is order block, V2 is fair value gap, and so on. The symbols equal, greater than, and less than are used to determine the position of one variable relative to another variable in our timeframe system. Greater than indicates that a variable is positioned one step higher than another variable in our timeframe system. For example, V1 greater than V2. If V1 is positioned on the 4-hour timeframe, then V2 logically should be positioned on the 1-hour timeframe. Less than means that a variable is positioned one step lower than another variable in the timeframe system. Equal means that a variable is positioned on the same step as another variable. We will also sometimes use the symbol greater than or equal to for some elements or combinations. Now that we understand this, let's move on to the logical elements. Using only 4 variables, I have managed to determine just 6 logical elements, which I have divided into 3 groups according to their function in the market. Logical element number 1, V1 inducement greater than V2 volume confirmation. This means that if we have a fractal point and the price performs a liquidity raid, then forms an order block, rejection block, or fair value gap on a lower step in our timeframe system, this logical element confirms the volume in the market. For example, if the inducement is on the 4-hour timeframe, then logically, the volume confirmation will be on the 1-hour timeframe. Logical element number 2, V1 volume confirmation greater than V2 volume confirmation. Here, the first variable forms an area of order block, rejection block, or fair value gap. Then the price tests this area and forms another area of order block, rejection block, or fair value gap on a lower step in our timeframe system. For example, a 1-day volume confirmation and a 4-hour volume confirmation. As in the previous example, this logical element confirms the volume in the market. These are the logical elements in the volume confirmation group. Logical element number 3, V1 volume confirmation greater than V2 inducement. Here, the first variable should be an order block, rejection block, or fair value gap, and the second variable, on a lower step in our timeframe system, can only be a fractal point. It should be inside or near the first variable. There are 2 methods this can happen. The first is that variable 2 forms at the same time as variable 1. The second method is that variable 2 forms after testing variable 1. For example, a 1-hour volume confirmation and a 15-minute inducement. Logical element number 4, V1 volume confirmation greater than V2 trigger. The logic here is the same as in the previous example, except that the second variable, the trigger, can be either a fractal point or a fair value gap. If the fractal point is clear from the previous example, then there are a few interesting details with the fair value gap. A fair value gap can only form at the same time as the first variable. In other words, the trigger must form within the volume confirmation. Another peculiarity is that the trigger in the form of a fair value gap cannot form within a volume confirmation that is also a fair value gap. I hope the logic is clear. For example, a 4-hour volume confirmation and a 1-hour trigger. These are the logical elements in the liquidity injection group. Now, the last 2 logical elements in the execution group remain. Logical element number 5, V1 trigger greater than V2 entry. Here, the first variable can be either a fractal point, which we also call IDM, or a fair value gap, and the second variable, depending on the trigger, must perform either a liquidity raid or rebalance the FVG on a lower step in the timeframe system. After that, it should confirm the volume through 2 methods, either order block or fair value gap, from which we can enter a position. We do not use the rejection block because it forms quite often on smaller timeframes and can be easily invalidated. Again, as an example, a 1-hour trigger and a 15-minute entry. Logical element number 6, V1 volume confirmation greater than V2 entry. The same logic as in the previous example, except that the first variable is one of the volume tools we use, order block, rejection block, or fair value gap. The second variable tests the first and forms another volume confirmation in the form of an order block or fair value gap on a lower step in the timeframe system, from which we can again enter a position. For example, a 15-minute volume confirmation and a 5-minute entry. It is important to understand that our entire strategy is built from these logical elements. Using these elements, you can construct your own methods for entering positions. It all depends on how you combine and use them. Now we move on to step number 3, where everything is already ready and you just need to use in practice everything I present here. Step 3, combo. To simplify, I've divided the entire process into two very important parts. The first part is the high time frame, HTF, where there are always just two variables. For intraday trading, these variables are most commonly found on timeframes like 1 day and 4 hours, or 4 hours and 1 hour. The second part is the low time frame, LTF, where there can be either 2 or 3 variables. Similarly, for intraday trading, these variables are often found on timeframes like 1 hour, 15 minutes and 5 minutes, very rarely 2 minutes. Every time we analyze the market, we first focus on the high time frame logical elements, which are only 3. 1. V1 volume confirmation greater than V2 volume confirmation. 2. V1 inducement greater than V2 volume confirmation. 3. V1 volume confirmation greater than V2 inducement. If we do not find any of these logical elements, we simply do not proceed further. We may not even look at smaller timeframes. All we need to do in such cases is wait, because the market rewards us when we wait for the right setup, rather than entering random positions. In the case where we already have a logical element on HTF, we can then wait for LTF logical elements, which again are only 3. 1. V3 trigger greater than V4 entry. 2. A combination of logical elements, V3 volume confirmation greater than V4 trigger greater than V5 entry. 3. V3 volume confirmation greater than V4 entry. Here, an important rule is that inducement and trigger cannot be combined. In total, we can receive only 8 combos to enter a position. Let's see what they are. First combo, HTF1, LTF1. This is one of the simplest and most widespread combinations. Second combo, HTF1, LTF2. We look for this when we do not receive the first combo, meaning we do not find the trigger and need to receive volume confirmation again to confirm the volume in the market. Third combo, HTF1, LTF3. We look for this again when we do not receive the trigger in the second combo, requiring us to receive volume confirmation once more, but only from the order block or fair value gap from where we can enter a position. Fourth combo, HTF2, LTF1. This is also one of the most widespread combos. Fifth combo, HTF2, LTF2. We need to receive this when we do not find the trigger in LTF1. Sixth combo, HTF2, LTF3. We receive this when we do not find the trigger in LTF2. The next two combos are more interesting because here we apply the rule that inducement cannot be combined with the trigger. Seventh combo, HTF3, LTF2. Eighth combo, we look for this when we again do not receive the trigger on LTF2. Everything is as simple as possible. That's all we need. But before moving on to real-life examples from the charts, we need to quickly clarify a very important rule in the market, and what trouble area and first trouble area mean to us. Step 4, an important rule, trouble area and first trouble area. The from zone to zone rule is one of the most important in the entire strategy. Its origin comes from the basic tenets of the smart money concept, from liquidity to inefficiency, and from inefficiency to liquidity. This means that price always moves from one zone of interest to another due to liquidity or inefficiency, which provided buying or selling volume in the market. However, it's crucial that all these zones are located on the same time intervals for them to function correctly. Thus, every move has a cause and effect, or more precisely, a point of interest and a target. This can be illustrated schematically as follows. For example, we have Zone 1 on the 4-hour time frame, which could be inefficiency or liquidity. In the context of testing and reaction from this zone, the price will likely reach Zone 2, also on the 4-hour time frame, in the form of liquidity or inefficiency. I hope this is clear. Following this logic, you can always identify the trouble area and first trouble area depending on the combo we have. Trouble area will always be on the same time frame as our point of interest, which is variable 2 from the HTF combo. First trouble area will always be equal to the trigger, which for us most often is variable 3. Always remember these formulas to correctly identify market conditions. You will understand this principle better when we analyze real situations on charts. Step 5. 2 combos that form most often. Since this video is more focused on the theoretical part, and to avoid making it too long, let's consider just the 2 combos that form most often. We will analyze the remaining variations in more depth in other videos. First example, HTF1, LTF1. The first thing we need to receive is V1 volume confirmation greater than V2 volume confirmation. On the one-day chart, the price forms a bullish order block zone, which can be considered variable 1. Now, to receive variable 2, we need to wait for a test and volume confirmation on the 4-hour chart. We switch to the 4-hour chart and see that the price forms a bullish fair value gap, which can be considered variable 2. Now all the conditions on the HTF stage are met, and we can move to the second stage, LTF. V2 trigger greater than V4 entry. On the 1-hour chart, the price has already formed a trigger, or what can be called inducement, which we can consider as variable 3. The last thing we need to do is determine the entry point. In other words, volume confirmation in the form of an order block, or fair value gap. We switch to the 15-minute chart and see that the price performs a raid on the trigger and then forms an order block zone, which can be considered variable 4, from which we can enter the position. But a very important aspect is the trouble area or target, where we will place the take profit. Remember that the target equals the point of interest. Thus, variable 5 will be the closest fractal or fair value gap on the 4-hour chart. In our case, this is the fractal high. If the risk-reward ratio is acceptable for us, we can enter the position. Here we have 1.75, which is not suitable for us. In this case, by risking more, we can place the take profit at the next fractal and get 3.28. We can enter the position. In this situation, on the 1-hour chart, equivalent to our trigger, we did not have a first trouble area, which is most often a fractal point or fair value gap, allowing the price to be delivered very quickly. Second example, HTF2 LTF1. Again, the first thing we need to receive is V1 inducement greater than V2 volume confirmation. On the 4-hour chart, we have equal lows, which can be considered variable 1. Now we switch to the 1-hour chart and see that the price makes a liquidity raid on these fractals and then confirms the volume by forming a fair value gap. All conditions on the HTF stage are met. Now, the LTF stage remains. V3 trigger greater than V4 entry. On the 15-minute chart, the trigger is formed, which will be considered variable 3. We need to wait for a test of the fair value gap on the 1-hour chart, and at the same time a raid on the trigger on the 15-minute chart. On the 5-minute chart, the price does this, and forms volume confirmation in the form of a fair value gap, which is variable 4, from which we can freely enter the position if the trouble area is at a convenient distance for us. In this case, the trouble area is the fractal high on the 1-hour chart, so we get a risk-reward ratio of 2.68, which is convenient for us. The position is closed at take profit. Here we can see, if we look at the 15-minute chart, that the first trouble area was in the form of a bearish order block, which acted as a stimulus for the price to test the entry level of our position. Part of all the materials in this video are posted in my Telegram channel. You can find the link in the description. I hope this video was informative and useful for you. Don't forget to subscribe to the channel, like the video, and leave a comment. See you later.